Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It is the 31st, the last day of May 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account. A lot to cover. The Fed, inflation. I think Fauci is speaking next week, which will be interesting. But, I mean, the dominant headline here, I mean, it's in the front of my Wall Street Journal, right? The conviction. Trump convicted. Should I frame this? Is this like frame worthy? I've got a couple, like Roosevelt closes banks and a couple other noteworthy things, but I don't know if this one makes it. Steve, what is going on here? And maybe most importantly, when will we get the polls to see if this energizes Trump's base, takes the independent voters off the table for Trump? Really, how do we think about the impact that this has?
Well, sure. I mean, it is historic. Whether or not you want to frame it, it's up to you. To have a former president convicted of this. Now, I mean, look, to be fair, there are oftentimes that juries and courts get things wrong. That's why there's an appellate process. I'd be shocked if Trump doesn't try to appeal the decision. I don't think the appellate process is going to conclude before November. And I think that sort of hurts him in a way, because were he to win on appeal, that would obviously help. I think now it's sort of a question politically, just looking at it, how much does it hurt? Definitely didn't hurt his fundraising, because he set a record, I believe last night, his website actually crashed. And it's sort of what you would expect. We're in a polarized world. So Democrats are pleased, Republicans are pissed. If you're asking me what a more powerful motivator is for voting, it's being pissed. I mean, Democrats benefited from that in 22 over the abortion ruling. I think the duration between now and November, although some people will start voting as early as September, is important, because
Some people have already voted.
Well, I won't touch that one.
And several times.
But I think that's sort of what, looking at 538, generally the left-leaning polling site sort of concluded, which I thought was helpful. Looking at polls, they sort of see more or less a 6-point shift, but 5-point really goes into the undecided camp. Biden only sees a 1-point bump according to their analysis. And granted, these are national polls too. So their sort of view is that 5% could potentially come back to Trump. That remains to be seen. Look, in terms of trying to appeal to swing state voters that are still persuadable, I don't know that it helps the way it did for the Republican primary, where it sort of used the political persecution rather than prosecution to rally support around him. I think, going back to the earlier comment, that duration, if this does really anger and energize these lower propensity voters that Trump really needs to rely on to have a chance in 24, sort of the way he did in 16, will they'll still be angry at that point. So I think the next thing to watch on the calendar is July 11th. That's the sentencing. That's going to come 2 weeks after the first debate with Biden. I believe it's 4 days before the Republican National Convention, and a harsh sentence there by the judge, which I believe probably has to happen before Trump files the appellate process. Could reignite some of this concerns and lead to a fiery convention on the Republican side. But
what
just
is
looking,
a low propensity voter?
Low propensity voters means somebody that doesn't ordinarily vote. And that's where Trump has had some success looking at 16. So there's this question of, and that's sort of one thing to take whatever the polls are saying with a grain of salt, is they have to make assumptions about what this electorate's going to be, who's actually going to show up. And presidential years, they've been pretty inaccurate as recently. Now, 2020, we had a record turnout, I believe, because of a lot of the relaxed voting restrictions with COVID. 2016, there was a lot of discuss with both candidates, and turnout was relatively low. And at that time, it benefited Trump, because you got a lot of anger. And again, a lot of these people that don't traditionally come out and vote benefited him, just because in these presidential years.
You don't get any more rock the vote campaigns on MTV, because rocking the vote now, trying to gin up support for people that, low propensity voters.
I think that's a good point, and I think that reflects the shift in the suburban vote, probably more towards Democrats. And Nate Cohn had an interesting take from the New York Times for something that's beneficial to Biden, in that he has made gains with some what were formerly traditional Republican voters, suburban voters, older voters, particularly older white voters that are more reliable. They're not these lower propensity voters. So his sort of rationale is, hey, you've sort of done the easy part by persuading some of these people that aren't usually in your camp. Can you sort of do something to rally your supporters. And in that sense, maybe this Trump conviction will help. But I would just be cautious as we sort of see the polls that come out over the next month or so. My guess is there's going to be some reflection here. I guess I would look more towards July, sort of after the sentencing, but, did that sort of reversion to the mean? Remember, we saw that bump for Biden after the March State of the Union. You saw him actually take, as a result of that, the lead in the betting markets, and then April, everything sort of reverted back to the way it was. So Biden began the month ahead of betting markets. Trump actually had a pretty noticeable lead. Now, some reports that betting markets crashed yesterday, but looking at the Real Clear Politics average of polls, it looked like there was a temporary bounce for Biden, and then things sort of went back to where they were. So if you want to use that as a barometer as to this is largely baked in, don't expect as much of an impact, maybe compared with something like the first debate. I guess that's sort of where I'm at right now.
Right. A vote for Trump is a vote for a criminal. I can already hear it being thrown out there, right?
Well, one thing you got to be careful though with that from the Biden campaign. It was interesting that they sort of made a tactical decision on, I believe it was Wednesday, where they had Robert De Niro and some January 6 police officers actually out there supporting the campaign. The challenge is going to be next week. The president's son has federal gun charges, and then he's going to face federal tax charges in September. So if you come out on the side of supporting justice, and that if your son's found guilty, that sort of puts you in a difficult political dilemma.
Shocking. Sicker than what? Sicker than your, what does your t-shirt say?
Sicker than your average.
I'm going to leave that to you. What happened?
It's from, don't you?
No, I don't have no idea.
Oh, okay. Well,
I'm not a boomer, but where's it from?
Notorious B.I.G.
The vodka triangle or whatever you call it, and it's a Notorious B.I.G.
Is that right?
Yeah.
Interesting. All right. I mean, I'm a fan. I have the catalog. I have the collection, so I should know that. I did. There is, when we did post it on Twitter, there is this new pre-made cocktail called Gin and Juice, sponsored by, of course, Dr. Dre and Snoop, and it's pretty good. But great way to put gangster life into the vodka triangle, I guess, huh? So what's going on with inflation, the Fed, and the rest?
Yeah, I mean, I think for me, I think the trade-offs are just getting a little bit more challenging for the Fed here. They seem to believe that, we have time to sort of see how things shake out, and, we can do, deliberately sort of move to our next decision, with respect to cutting. And okay, I mean, I understand that, but I also think you never really have as much time as you think. I think that's what the historical record tends to show. And, my sense is that, the economy is moderating. I don't think growth is clearly not getting away from the Fed. There's really no evidence at the moment that there's some sort of cyclical upturn in the economy. I mean, if you look at building permits, they've been slowing. I think they're the lowest since January of 2023. Single family building permits have declined for 3 months. Pending home sales, which are a leading indicator for existing home sales because they represent signed contracts, that's actually come down to its lowest since the pandemic. And we saw this morning that consumer spending has been slowing. If you look at the trend, it's running at about 2%, which is fine. I don't want to light my hair on fire here, but there's no evidence that that growth is getting away from the Fed. I mean, the consensus went into the year very cautious, adjusted higher, which made sense, and now we're sort of on the right side of the 8 ball. On inflation, I think the evidence is that inflation is likely to improve over the coming months. What I find very interesting is that if you look at the month-over-month change in core inflation every month this year, it's lower than the sequential rate of change in every month of last year, right? So April of 2024, inflation rose more slowly than in April of 2023, which is true of March, February, and January. So if that continues, if that pattern continues through the spring and the summer, it's going to mean a fairly meaningful slowing in inflation is on the horizon. Okay. So that's kind of where I'm at. And if the Fed doesn't recalibrate policy, what does that mean? They're basically passively tightening by doing nothing. And that has consequences, especially at a time when the labor markets have cooled, right? So that's why I say the trade-offs are less obvious, right? If you look at the rate of nominal growth, it's actually running slightly below the rate of the overnight Fed funds rate. So I think it's sort of incumbent on the Fed to kind of not really push this "we have time" argument that far. You should keep that on a very short leash. And my hope is that they kind of react, and their Fed speak changes very quickly in the face of the incoming data, because all the Fed hawkishness that's out there right now is purely a function of the first 3 months of the year being bad. And if the next few months of the inflation data are good, then you'd expect their tune to change. If it doesn't change, then I think you'll probably see a bigger rally in fixed income than you would otherwise, right? Because it just means, that they've overstayed their welcome with this higher for longer stuff, they've overstayed their welcome with tight policy.
Right.
So that's kind of where I'm at. And as I mentioned, there's really not much evidence that growth is taking off. I mean, it's just not there. There is evidence that we should expect inflation to keep slowing. And I think that's what the Fed should be focusing itself with.
I mean, from a markets perspective this week, and I think we're still in this hangover from the momentum peak that we had back in April. But you did start to see fissures in industrials, which was behind tech, the second largest constituency of momentum names. You did see cracks. Some of those cracks look like canyons in software, CRM. A few other notable names now, et cetera, coming under pressure. So one area of tech that was former momentum, now absolutely being dismantled. Semis have still been strong, but we've pushed that sentiment back into the zone where we were back in March. And so I think that makes for some vulnerability there. And it just looks like a grind. It looks like that Q5, the anti-momentum trade is more viable than we see with the momentum trade here. Again, the exception being probably Nvidia, but even that one looks vulnerable from an option sentiment standpoint. So, the high end of what you're talking about from an equity market perspective is there. What's interesting, the things that we look at to say, hey, has the Fed pushed it too far? Are we about to hit recession? Is this, bad news for equities? We're still not seeing migration into things like staples. They're not catching a bid. We're not seeing an overwhelming advantage in healthcare. Certainly, we've seen a really good bounce out of utilities. That seems to be a quasi AI play and kind of the realities of what we need for energy and power going forward. But that's global in nature too. We're seeing good performance out of China. We're seeing good performance out of Japan. We're seeing good performance out of the European names in utilities there as well. So very, very unusual. To your point on inflation, I mean, one of the key markers for us when we go through a look at inflation and the market's reaction is what's happening in financials. Financials do not do well in the face of rising and deteriorating inflation. And that's just not the case. Financials have held up well. They still look good. They look good globally. And I think that certainly bodes well for what we're seeing. We did see new highs in German yields. We're on the precipice of new highs in the UK that might have happened overnight. We've seen new highs in French yields, obviously the US. So pretty important that these things stabilize, if not actually turn lower. Obviously, the Fed could help do that, but I think that's one of the risks. Is exactly to your point. It feels like from the market's perspective, the Fed might be overstaying their welcome, and we're seeing some of the impact on that. The percentage of issues above their 200-day moving average in the in the Russell 3000 is now at the lowest level of the year. So it's actually been contracting as we went on to make new highs. And, as we punch through that previous high, which was 52.58 on the S&P, we've now since come back below that, right? So we had a pivot point and then we have a failure. And that's one of the things that we look for. Not catastrophic by any means, but just kind of sets up for that grind, particularly given where sentiment was after momentum. In terms of next week, Steve, I think there's a few people chitter chatting on the to the House and the Senate next week. What's who's on store or who's in store to be at the grilling?
Well, we'll have some hearings next week on artificial intelligence in, I believe, both chambers. So that'll be interesting to those in that space. I know you referenced semis earlier, so that'll be something to keep an eye on. But really, I'm going to be watching Monday in the House. Anthony Fauci is coming back to testify, even though he's no longer in government. Sort of give him credit for doing that because it's a risky position. I don't believe he's under any obligation to do it, but I don't know that there's much upside for him there. And just going back to the COVID pandemic, maybe shed a little more light on as to the decision-making process. And hopefully, without being too political, be some lessons learned moving forward. I don't think anybody wants to relive that. I think there were a lot of decisions made that maybe in hindsight don't look that good. So that'll be the optimistic, less political view with respect to that, but something to watch nonetheless.
Yeah. Neil, what's happening next week?
Well, it's a busy week. Next week, we're going to get ISM. We're going to get employment. So kind of the first take on May. Right now the consensus is looking for continued sort of moderate payroll growth in the private sector, around 160,000 for May, with the unemployment rate flat at 3.9%. I'm going to keep a close eye on hourly earnings. Hourly earnings have been slowing quite meaningfully over the last 3 months. You'd expect some rebound in May, and I think that's largely what's going on here. But the broader trend is that average hourly earnings growth has been slowing, which would sort of speak to this idea that labor demand pressures have been cooling. So I think that's notable. But when you take a flat work week and you put on 0.3% hourly earnings and 175-ish thousand on jobs, I mean, you're really talking about like 4.5% to 5% nominal income, which again speaks to this idea that the trade-offs are not as obvious anymore about keeping the funds rate where it is. We'll see how the labor markets go, but my sense is that you'll continue to see this moderation in wage inflation.
Well, we got the market cycle clock update next week, so we'll look forward to that. And hopefully, to your point, we'll see that inflation cool and move us into a more favorable zone again. That would be certainly welcome. One thing, just on China, we made a big call on China as a secular trend change, and that is still in place. The momentum has softened and it's actually pulled back, and I think that's fine. What I would say, though, is usually really strong momentum, acceleration walls, as we call them, don't give you a chance to buy them. And this one's giving you a chance to buy it. That doesn't negate the trend by any means, but just does not make it as powerful of a momentum market as what we would otherwise have thought or believed that we were facing back a week or two ago. But still looks very, very supportive from a longer term standpoint of a positive trend developing in China. And actually our favorite preferred is Hong Kong. So the HSI index there. In terms of the S&P, support 49.54, the 10-year yield support 4.35. Would love to see the 10-year down below that as we go. And then with some of these recent announcements in crypto, looking at 72,800 as the Bitcoin breakout that reestablishes the trend. 59,755 is support there. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and LinkedIn. And if you want deeper insight, you can go to renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
We'll see you.